Hey, what's up, everybody? My name's Kepley. You're tuning in to howtoPlayStock.com. Today is July 8th, 2016, and I said in a previous video that I was going to cover the topic of manual trailing stop losses. So that's what I'm doing today, is I'm going to cover a video on that and exactly how you go about placing your manual trailing stop losses on trades. That way you can lock in your profits and ride the uptrend on your currency pair without losing any money. Okay, now it's very important. I'm going to shoot a two-part video here, and it's very important that you pay attention to the broker spread. I mentioned this in a previous video, but I didn't really cover it in great detail with you. I'm going to do that first for this video, and then I'll cover the manual trailing stop loss. And the reason why you want to focus in on the broker spread is because this is how the brokers get paid, for their commission, so that they can make money off of you for actually using their platform. So getting started here, and to basically stay away from any type of confusion that you might have, I'm going to cover the broker spread, and I'm going to show you what you need to pay attention to when you're placing your trade. Now, the scenario that I have here, it's just a hypothetical scenario. I want you to know before we get started here that the pips that I'm using on the price for the currency pair in this example is not exact. I didn't do any pip calculations for you on it, and I did that on purpose so that I'm not confusing anybody by explaining pip calculations, because honestly, to tell you the truth, if you're trying to calculate out your pip calculations while you're doing a trailing stop loss, it can get rather confusing really quick. And that's the last thing you want to do if you're doing a manual trade and you're watching your trade and you're trying to calculate everything out on a calculator. Honestly, I've tried it. It really doesn't work. So for the sake of confusing folks on pip calculations, I'm going to stay away from that, and I'm going to show you a way it is a little bit. It's much more simple, in regards to tracking that kind of stuff, and it'll help you when you're sitting down, at the monitor and you're tracking your trade. It'll help you basically lock in your manual stop loss a lot easier than having to go in every 5 seconds or every 10 minutes or whatever and calculate out your pip calculations. Because it's a live trade. You don't want to create any type of confusion for yourself or lose track of what you're doing. And I can tell you from experience, when you're trading on a forex currency pair, it can get pretty volatile, so the price can go up and down quite a bit throughout your trade, and you'll get fluctuations in the price of your currency pair. Your profits can go up and down rather quickly. So that's why I'm showing you what I'm showing you right here with the broker spreads, and I'm staying away from showing you the pip calculations, because you really, honestly, you're not going to have time for that. So getting started, when you guys log in to your broker platform for trading currency pairs, you're going to see something similar to what I have here at the very top. Okay, and it may vary a little bit, but every broker is going to lay it out in a similar format. And that format really is, you're going to have your type of trade up here. So it'll be buy or sell, okay? You're going to have a lot size. And for this example, we're going to go with the 0.01 lot size. The reason for that, again, is for risk management purposes. If you're a beginner, you don't want to lose your money, or you want to avoid losing as much money as possible. The easiest way to do that is to go with a 0.01 lot size. This is your currency pair right here. For this example, we're just using the Euro USD. This is your price right over here. And then you're going to have something that says T/P, which is take profit. Okay, now when you start your trade, when you initially start out your trade, you're going to start out in a negative profit. Okay, and this is because your trade has to get out of the broker fee before you can actually take a profit. Okay, it's set up this way on purpose so that the brokers do make money off of people trading on their platforms, and it's pretty much guaranteed that people are going to lose trades and there's going to be people that win trades. So they have to make their money somehow, and this is how they do it. So when you first start, you're going to start negative. For this example, we're starting at negative $3.50. All right. Now this next piece here, I'm going to show you what you need to do as you're getting out of your broker spread. All right. So let's just say down here, I don't know if you guys can see this, but down here you have your price. That little red circle, that's where you're going to start. And I drew this out kind of based on a chart graph, you know, seeing what you're going to be looking at on your charts, which is just the movement of the currency pair going up and down. So we're going off of that. What you need to do when you first place your trade is you need to basically remember, well, I guess you really don't need to remember the price that you start at because you're already in a loss. So if it goes down from there, I mean, you know, I guess you can go ahead and sell or just stop your trade and get out, but you're going to be in a loss anyways. So there's really, you really don't have to pay attention to it that much. You'll want to pay attention to the negative price up here. So what you're trying to do though is get out of this negative price and get out of the broker fee so you can at least break even, all right, and get your money back. So if you're starting out here where I've got this little red circle, your currency, of course, is going to go up. All right, we're just using a hypothetical scenario here where the currency pair, you know, takes off right as you place your trade, and you placed a buy. Okay, so buy means the price is going to go up. So in this example, the price is going up off of chart movement. All right, but it's not going to break even until, let's just say, right around in this area right here where I've got this blue circle. Okay, your price started out at 1.1025, and when it hits the blue circle area right here, the price is at 1.1087, for instance. Okay, now this is not an exact pip calculation that I've made here. This is just for the sake of explaining the concept to you. So this area from the red circle to the blue circle, that area right there, that makes back the broker spread. Okay, when that happens, what you want to do is remember, I don't know if you can see this down here, but I put remember this price right here where the blue circle is, which would be this same area. You want to remember that price, okay? And the price was 1.1087, so you might want to write that down as the trade's going out. Just get a little notepad and jot down the price, okay? So at least you have it remembered. That's important because at this point, you've made back your take profit. So at this point, you're no longer negative. You're going to be at $0, all right? And you want to remember that price that it broke even at, because if the price starts going down on you and it goes under that, you can wait to see if it comes back up out of the negative territory, or you can go ahead and just get out of the trade and at least have a chance to break even, okay? That's what you want to do when it comes to the broker spread, okay? Now, once you're here and you're breaking even, from that point on, if it keeps continuing to go up on you, like the price movement on the charts, from that point on, you're in a profit, okay? And that's what I'm going to do now is switch gears here, and I'm going to shoot a second part of the video on the manual trailing stop loss and how you actually go into calculating out a certain percentage of profit and tracking that as the trade progresses, okay? Okay, so now that we have the broker spread out of the way, we'll go ahead and cover the manual trailing stop loss. So let's just say that you've already broke even, okay, on your broker spread. So at this point, any price movement going upwards, you're in a profit. Now, before you ever place your trade, guys, what you want to do is basically set a percentage, okay, in profits as your figure to determine your trailing stop loss on the price of your currency pair. Alright, so what do I mean by this? Basically, you want to, if you're doing a trailing stop loss, you want to set aside a certain percentage of profits where you lock in your profit. Okay, so in other words, if the price goes down from where you lock in your profit, you're gonna take your profit and get out. All right, but you want to set aside a number, a percentage in profits that you're going to be okay with. All right, so if the trade goes against you, at least you can get out with something, instead of losing on your trade because you are basically hoping that the price goes back up after it starts dropping. All right, hopefully that makes sense, because what happens a lot of times with people when they're in their trade is they won't have this planned out. So what they'll do is just watch the price go up, and they're in a profit, and they keep thinking that the price is going to go up. Okay, and it's a psychological challenge to get over, and this is the biggest part, or the biggest reason why day traders lose money, is because the psychological aspect of it, when it comes to their emotions, it gets the best of them, and this is how it gets the best of them, is they sit here and they get in the trade and they get into a profit, and then they think, oh, awesome, it's going to just skyrocket to the moon forever, and that's not the case. What ends up happening is they don't have this number that I'm getting ready to show you here, and they don't have this plan set out before they even get into the trade, so they sit there and they keep thinking it's going to go up, and then it starts dropping on them. Well, they never have a stop loss in place, so what happens, the price just keeps dropping on them, and they keep sitting there hoping that it's going to go back up, and before you know it, they've lost money and they're now in the negative. So what you want to do is stay away from that, and the best way to do that is where I'm going to show you with the plan that you need to get together before you even place your trade, and this will help you from avoiding the psychological, emotional challenges that you are going to encounter in your trade. So what you want to do is set a percentage in profits as your figure to determine your trailing stop loss price on the currency pair. All right. Now, for this example, let's just say you had $500 to invest in a broker, so you can start playing Forex. You have $500 to invest. Now, you're going to place a trade at 5% of your $500. Remember? I said this in a previous video. You only want to play with 5% of your money. I'll leave the rest in cash reserves. The reason for that, it's a money management strategy, and it allows you to keep your money and not lose it all on one trade. So just play with 5% of 500. So that would be $25 for the trade. And this is just an example, okay? If you have more money, you can obviously raise that number. But for this example, it's just $25 for the trade. Excuse me. You want to start a trailing stop loss. For this example, we'll just say it's 10%. Okay? So what you want to do before you ever place your trade is take 10%, because that's the increase in profits once we break even, that we're going to lock in our... That's the profits we're going to take. Okay? And that's what we're going to lock in. So 10% increase in profit on the trade. 10% of $25 is $2.50. All right, so that's, once you're in a profit of $2.50, what you want to do at that point is remember the price of your currency pair. Okay, I'm going to erase what I have here on the board, just so you can kind of see what I'm talking about from a visual perspective. So, for this example, all right, let's say you've already basically made you broke even. You're out of the commission fee with the broker. From this point on, we're going to start from the break-even point. So the break-even point's down here, and we're going off of a chart and the price of your currency pair. Those are the two things you want to watch. So down here, let's say the price of your currency pair, I don't know, let's just say it's at $1.12, okay, and some pips behind it here. Now you've broke even already, so at this point what you're doing is you're going to take your profits. So let's say, just a hypothetical scenario, you've been tracking it, and your trade hits $2.50, which was that 10% that we were looking for on your profit. Okay, so your profit now, which was that number that I showed you earlier over here in the right hand corner, that negative 350 that you first started out with, that's the number you want to watch after you've broke even, because it should say $0, and then as it moves up, it'll turn green, so you're in a profit. But your profit, we're going to say, is $2.50, which was that 10% increase we were looking for. So it hits $2.50, great. Now you're in a profit. Now what you want to do, from this point on, is you're going to remember, again, all you do is just remember the price that the currency pair is at. So let's say it hits the 250 in profit. Okay, but the price, let's say it equals, I don't know, $13.50 or $13.51. Okay, and that's the pips. Don't pay attention to the pips because these aren't exact calculations. I'm just trying to show you the concept here of the trailing stop loss. So disregard the actual pip count between the starting price and the price we're at now for your $2.50 profit. So you're at $2.50 profit. What you do though is you want to remember the price that it's at, your currency pair, when it hits that $2.50. Okay? Write it down, just like you did with your break-even price. Because now what you're going to do is you're going to continue your trailing stop loss. So if the price continues going up, just keep tracking it, but you'll do another 10%. Okay? And you're doing it, you're basically doing this in 10% increments. So the best way to do it, to calculate calculate it out, is just take what's another 10% on top of the 10% we already have. That's 20%, right? So take 20% on a $25 trade, and you're at $5. Okay? Does that make sense? That's 20% of $25 is $5. So at this point, what you're doing, you've already locked in your $2.50 profit. If it continues going up, go ahead and trail your profits. If it drops and it hits your price, remember your price, your currency price. If it hits your currency price that you wrote down that gave you that $2.50, go ahead and stop the trade and get out. Because now you're in a profit, you can take that small little profit and use it for your next trade. Okay? Now don't be greedy with this, because again, this is how people lose money, is they get greedy and they think that it's going to go up forever, and it never does, and then it hits their $2.50 profit, but they don't have any type of plan in place, and they just let it drop. and it continues to drop and continues to drop. And before you know it, they're in a negative territory again, and they've lost money on the trade. So you're not trying, that's what you want to avoid. So once you've got your $2.50 profit, and it hits your currency price that you wrote down when you got your 10% profit, go ahead and get out. But if it continues going up and it never hits that price, let's say it drops a little bit, but it doesn't get down to the currency price that gave you the $2.50, go ahead and let it ride out, because it can go back up, some more. And what you do at this point is ride it up until, if it continues going up for you and it never drops back down to your $2.50, you're gonna wait until it hits $5 in profit. So you remember that figure, that little currency figure that was red when you initially started at negative 350? You'll watch that until it hits $5. When it hits $5, now you add another 10% increase onto that number, okay? So it'll be basically, you'll calculate it out, it'll be 30% of $25, okay? And then that's the number that you're going off of for your profit, okay? Just like what I showed you here. So 10% was $2.50, another 10% gave you $5, and so on. And that's how you do the trailing stop loss, guys. Okay? And this is very important. You want to write this stuff down and get it planned out before you ever place a trade with your broker, because this will increase your odds of winning, tenfold. I've been trading Forex currencies. I traded them for about 10 months. I'm not doing it right now because I kind of switched gears in regards to my investing plan, and I wanted to work more on my long-term investments, because I really, I got to a point where I didn't feel like I had enough money set aside in cash reserves that I could afford to lose on trades if I started losing. So I got out of the currency market for a little bit. I'm going to jump back into it here. I don't have a set time frame for that, but I do pay attention to the currency markets, and I've been doing some more research and reading books on different strategies for the current currency market, because if you do this and you place, you got your plan laid out like I'm showing you right here, I can tell you right now, just based off my own experience, you're going to be looking at least an 80% win rate on your trades, and you'll be able to basically use momentum to your advantage when you're placing your trades, and you just keep accumulating more money and make more profits, and your trades will get bigger. So the amount of money that you'll be able to take and lay down on each trade is going to get larger. Therefore, your profits will start getting larger for you too. Okay, so instead of looking at a $2.50 profit, starting out with $25, you might be playing each trade with $100, and your first 10% is $10, $10 profit instead of a $2.50 profit. So that's it. You can make a lot of money with this. Okay, just remember that 80% of it's psychological and emotions. So in order to avoid that and get around that, you just set yourself up a plan like this for a manual trailing stop loss. Now you might be asking, can you set up an automatic stop loss? Yes, you can. The problem with that is that if you set an automatic stop loss, a lot of the professionals and experts that do currency trading will tell you they don't even use an automatic stop loss. They'll do the manual trailing stop loss, because more often than not, when you use an automatic stop loss, you'll end up losing on more of your trades. Okay, because you can't, it takes emotions completely out of it, and it doesn't even give you a chance for the currency to rebound. Okay, so you can do that if you want to, and that'll pretty much guarantee that you don't lose money, but your chances of letting your trades ride out into profits it's going to be reduced. Okay, that's all I have today on the manual trailing stop losses. If you want more information on the foreign exchange currency market, Again, you can check out my websites. I'll leave links in the corners here. But other than that, be patient, guys. And remember, in comes the outcome, all right?